Wow, 2022 has been crazy so far. We're only a couple of months in and it's been a mad year. It really has, especially for investors, because the stock market has been, well, it's been doing everything. It's been up, it's been down, it's been sideways. I'm surprised it hasn't gone round in circles. It's just been all over the place. And for investors, it's not been a particularly fun time because a lot of us have been seeing things in the red. And the question on a lot of people's lips has been, are we heading for a recession? Well, I thought I'd look into this and look into some of the information and data that's available to see if we are potentially heading for a recession. Now, according to Ed Clissold, I hope I've said that correctly, of Ned Davis Research, there are three main factors that generally sends the US economy into a recession. They are an inverted yield curve, a spike in commodity prices, or Fed tightening. Now, I know I've just said US economy on this one, and this is a UK-based finance channel. But generally, whatever happens in the US generally happens here in the UK. Our economies kind of mirror each other in a way. Well, our economy generally mirrors the US economy. So it's useful to talk about what's going on over there because they are the biggest economy in the world, because it will have an impact on us as UK-based investors. So let's look at some of these things in a bit more detail. So the first one is the inverted yield curve, and to describe this simply, it's when the yield of a short-term asset, in this case the 2-year US Treasury bond, is greater than that of a long-term asset, in this case the 10-year US Treasury bond. Now currently we're not in an inverted yield curve because the yield on the 10-year Treasury bond is still greater than that of the 2-year Treasury bond, and if you look at this chart you can see we're still in that positive territory. But if you look at the trajectory of that chart over time, you can see that things are heading towards zero, which means the curve is flattening. And what we don't really want to happen is that to turn into a negative. So the yield on the 2-year becomes greater than that on the 10-year. And the reason for this is because historically, when we have gone through an inverted yield curve, a recession has followed. In fact, it's the one indicator that has correctly predicted a recession between 1955 and 2018. Which means that's better than Mystic Meg. But that is a really good indicator that we're potentially heading towards a recession. It's also a far-reaching indicator as well, because when an inverted yield curve happens, it's usually 6 to 24 months after this happens that the economy enters into a recession. So it's something we don't really want happening, because usually when this happens, well, every time this seems to happen, we head towards a recession. So we don't want to go into an inverted yield curve, but say at the moment we're still just in the positive, but it is becoming very close, the yield between these two bonds. So the second one is oil prices. Now I'm sure we're all starting to feel the effects of this one because energy prices and fuel costs are going up everywhere, from gas to fuel to petrol, diesel, you name it, everything's going up. I know I'm feeling the pinch on this with my 27 mile per gallon Lexus. Oh, how I love driving Japanese luxury cars. Anyway, on with the video. But a spike in oil prices has been a signal that a recession is coming. And if we look at this chart, over the last 50 years, every time Brent crude oil has rose 50% above trend, a recession has followed. So that's a pretty good indicator as well, and we're currently above that situation as of March 2022, because as we know, oil prices are stupidly high at the moment. Now they are fluctuating a bit and they may have come down as of recording this video, but they're still really high, so it could be a signal that we are heading for a recession. And the third one is the tightening of monetary policy by the US Federal Reserve. Now currently we're almost going through a two-stage tightening process, and to explain why, I need to go back to March 2020. You know, when the world went mad and we went into this global pandemic? Well, when that happened, to try and stop the US economy from going into recession or crashing, whatever you want to call it, Jerome Powell turned on his magic money printer and started buying billions and billions of dollars worth of US Treasury bonds and mortgage-backed securities. And that happened all the way up until this month, March 2022. But in November 21, to try and combat the rising inflation that was going on, which was going to happen because you're pumping billions into the economy every single month, they started to lower the amount of these assets that I was buying every single month. And they actually ramped this up in December 21 because they realized they needed to do this tapering quicker. And they tapered it all the way down to March 2022 because they're no longer buying any of these assets. And that moves us on to stage 2, which is the raising of interest rates. So now they've stopped buying the assets and stopped pumping money into the economy. They're now trying to raise interest rates to try and slow down the flow of money in the economy economy because they want to calm it. They want people to almost stop spending and start saving. And that's why they raised it by 0.25% in March to 0.5% in total. Now, there are more rate hikes planned throughout 2022 to try and help curb this inflation. Now, when it comes to monetary policy, the Bank of England has actually been ahead of the US Federal Reserve on this one because we haven't had such big money printers. Yes, we have put money into the economy in the UK, but not to the level of the US. And also, we were much quicker to start raising interest rates here in the UK. In fact, over the last couple of months, we've already had 3 so far, and there's more planned throughout 2022. So we're actually ahead of the curve for once, which is surprising for the UK. But these 3 things are all indicators that a recession is coming. And currently we have 2 of those 3 things, and the third one isn't far away. So it's generally not looking good for a potential recession. It looks like one could be coming. But we're also in pretty unprecedented times. As I've already mentioned, we're coming off a global pandemic. Nobody knew how this was going to play out. Nobody had any data, any information to look at because nothing like this has ever really happened before. The world has never gone into lockdown. It's never been the insane thing we've had for the past couple of years. So even though we have got all this information and data to work from what's happened in past recessions, we're also in pretty unprecedented times, and it's going to be interesting to see how things play out. Unfortunately, I don't think it's going to be great how it plays out in the short term, but hopefully in the long term, it'll be quite good. But we are also facing other issues in 2022 as well. Supply chain issues are still a problem around the world. And this has been even more exacerbated by the Black Swan event that's happened here in 2022. And I'm going to be serious for a minute on this one because what's going on in Ukraine is completely beyond comprehension. I literally cannot get my head around what's going on, what's happening to all these people, the completely senseless killing and destruction of a country that basically just wanted to get on and live its life just because of the will of one person who has this idea of what he wants to do. And I just can't get my head around what's going on over there. It's completely incomprehensible to me, and my thoughts and my heart goes out to anybody who's been affected by this, whether directly or indirectly. I just can't get my head around it, and I really hope that this ends soon. Not for the financial impact, I don't really care about that for this. For me, it's the humanitarian impact. So I want people, the Ukrainian people, to hopefully be able to go back, start rebuilding their lives, start rebuilding their country in a time of peace, because that's what people deserve in 2022. It shouldn't be happening. A lot of people don't agree with this, and I'm completely behind them. This shouldn't be happening in this year, and it just shouldn't be happening full stop. So I hope the conflict does get resolved soon so the Ukrainian people can start rebuilding their lives and their country. But there is a financial impact of what's going on in Ukraine at the moment. It's something we do need to think about and we need to talk about, because basically, Russia's been sanctioned from pretty much everywhere. And this is causing more supply chain issues because Russia is a huge supplier of oil and gas to the world, and combined, Ukraine and Russia are big suppliers of wheat. So we are expecting things to continue to go up in price. Inflation is going to go up as a result of what is going on in the Ukraine. So we are going to be feeling the pinch of this throughout 2022 and possibly into 2023 as well. So are we headed for a recession? Well, honestly, I don't know. But when you look at the information and the data that we have available, all signs are pointing towards something happening. And it would be surprising to me if it didn't happen. Because if you look at the time periods between recessions, it's like we're almost overdue one. Now, I don't class the flash crash of 2020 as a recession, because when things started to go wrong, all governments around the world just turned on the magic money printers to try and stop things going into recession. And people might disagree with me on this one, but I think they should have actually let the recession happen in 2020. Yes, it would have caused pain and people would have suffered because of it, but we'd have been coming out of that now. Instead, they just basically kicked the can down the road, and it could actually be worse now than what it would have been then. I hope you understand my logic on that one. So I'm not sure if it's going to happen, but I wouldn't be surprised if something does happen when it comes to the economy and recessions over the next few months. But what can we as investors do about this? Now, obviously, I can't give you financial advice. I'm not a financial advisor. I'm just going to say what I'm going to be doing. And that's pretty much the same as most of the good financial YouTubers here on YouTube. And that is, I'm going to continue investing every single month. I don't know when anything's going to happen. I don't know if anything's going to happen. I'm definitely not going to try and time the market. So I'm just going to continue making my monthly regular investments, buying into my globally diverse fund, and letting it do what it's going to do. Instead, I'm going to focus on managing my money better and also trying to make more money as well, and just let my investments do whatever they're going to do, because I have no control over the market. So I might as well just sit and ride out this crazy roller coaster we're on and see what happens in the end. So I hope you found this video helpful. If so, a like would be absolutely awesome. Also consider subscribing for more money related content. So thank you so much for watching, guys. I really do appreciate it. Stay awesome, and I'll see you in the next one.